Buy-side survey suggests that long dollar positions are the most crowded trades in financial markets. And we've seen a 3% correction in the dollar over the last month. So does that mean that the dollar's topped? We think the short answer to that is no, and we're going to give you 3 reasons why we think that to be the case. The first reason is the Fed. We think the Fed still has another 125 basis points of tightening to do this year. That's going to take the Fed policy rate up to something like 3.25, 3.5%. And that's a really high rate for the world's preeminent reserve currency and will attract a lot of global deposits. The second factor is energy. Here, gas prices continue to surge, and that really damages the trade accounts of large energy importers like Germany and Japan. These countries have seen their traditionally large trade surpluses wiped out. And that will emphasize the energy independence of the states, which is a very positive factor for the dollar. And the third factor is overseas growth. For a dollar turn, it's not just enough to see a slower US economy and softer Fed rates. We really need to see an attractive overseas investment destination. And given that we're looking for a recession in the Eurozone in the second half of this year, and Chinese growth forecasts are being revised down all the time, there just isn't that pull factor of overseas markets to take money out of the dollar. To conclude, we see the dollar staying strong the whole of this year and not turning until the first quarter of next year, when there are much clearer signs of a US growth slowdown and Fed easing expectations really start to drag the short end of the dollar interest rate curve a lot lower. You can find out a lot more on this subject in our recent publication, FX Talking, and you can find that on ing.com/think.